Okay, hello and welcome to another tutorial video. This time we're going to go back to venture capital and startups and learn about Safe Notes, an alternative method of funding startups. So for all the files and resources here, you'll want to go to breakingintowallstreet.com/kb/venture-capital/safe-notes. I'll also pin this URL right below the video. This is another excerpt from our venture capital and growth equity modeling course. And what this tutorial is about is that two of the most common ways to fund an early stage startup are priced rounds, where the venture capitalist invests a certain amount at a certain valuation and gets a certain percentage ownership, and then Safe Notes. SAFE stands for Simple Agreement for Future Equity. The difference is that with Safe Notes, the investors do not get direct ownership in the startup right away, so they do not get any shares when the investment first takes place. Instead, they get their preferred shares later when the company raises its first price round, such as a Series A round following a seed round. Now, in theory, Safe Notes are faster and cheaper than normal priced rounds, which is why some startups prefer them and why many startup incubators push them quite heavily. And two prominent people involved with startups, Paul Graham from Y Combinator and Fred Wilson from Union Square Ventures, have weighed in on this issue. Paul Graham was the person who actually pushed Safe Notes back in 2013. Fred Wilson felt that they were not in the best interest of startup founders in most cases. So we're going to look at how they work here and then see who was correct on this issue. So in this lesson, we'll first look at how Safe Notes work in a seed round for a startup. Then we'll see how they convert into actual shares in a Series A round. Then you'll learn how an options pool in the Series A round or an options pool resizing can make things even more complicated. And then you'll learn about whether Safe Notes are worth it. This last part is mostly my opinion, but it is backed up by some of the numbers we go through here. So let's start with Safe Notes in a seed round. The thing to understand here is that when a Safe Note investment takes place, nothing actually changes with the shares or the options or the ownership in the company. Let's go to Excel and look at our example here. We have a company that is worth $12,000, almost nothing, and the co-founders own 1.2 million shares. There is an options pool for the employees. The employees own around 10% if you assume full dilution from those options. And then the co-founders own around 90% of the company. And these two firms, Alfheim Capital and Asgard Capital, each invest $1 million in the startup. After this investment takes place, they still do not actually have shares in the startup. So they still have no direct ownership, and it is still 90% co-founders and 10% management team after this. Now, you will notice that there are some other terms here, namely a valuation cap and a conversion discount. The valuation cap here says that this is the maximum value at which they can actually convert their investment into shares in the next price round. And then the conversion discount tells you if you know the share price in this next price round, this is the discounted rate at which this particular investor, Alfheim Capital, can get their shares in that next priced round. So there are terms attached to these. It's just that they don't actually result in shares in this first round, the seed round investment right here. Now, if you go to the Series A round, here the scenario is that the startup raises $5 million at a $10 million pre-money valuation. And so the VC firm expects to own around 1/3 of the company. To show you how the math works, the investment size is $5 million. The supposed or apparent pre-money valuation is $10 million. And so the VC here would expect to own $5 million divided by $15 million, or about 1/3 of the company. So that's how things are supposed to work. But if you have Safe Notes involved, it gets a little bit more complicated than this, and that won't be the exact ownership. Step one here is to calculate the price per share in this Series A round, which we can do by taking the pre-money valuation and dividing by the pre-money share count. So here, for example, we can take our pre-money valuation of $10 million right here, and then going up and dividing by the total number of shares that existed prior to this after that seed stage investment, the seed round investment took place, we get to a share price of $7.50. Now, the next step is that we have to determine the price per share that the Safe Note investors will get in this round. So for the first one here, Alfheim Capital, they're getting a discount, which means that we just take this Series A price per share and we multiply by 1 minus this 20% discount to reflect the fact that they'll be able to get shares based on 80% of this share price of $7.50, which comes out to $6 right here. And then for Asgard Capital, this is based on a valuation cap instead, which means that we take this valuation cap and then we divide by the total number of shares that existed just before this round. So this actually comes out to $7.50, which is the same price that the Series A investors are paying. The next step is to calculate each group's new shares in this round and the valuation of those shares. And we can do this by taking the investment amount and then dividing by the share price for each group. And this is now different because of the way safe notes versus price rounds are structured. So for Alfheim Capital, let's go up and take that $1 million. We'll divide by the $6 share price. For Asgard Capital, we'll take their $1 million and divide by the $7.50 share price. And then for the Series A investors, we'll take the $5 million that they're investing and divide by the $7.50 share price. We can add up these shares. And then for the valuation, we can just take these share counts and then multiply by the overall Series A price per share right here. So we have that. And you can see how the group that got a discount here is effectively getting a boost to their valuation as a result of that discount. We can also look at this as a multiple of invested capital. And you can see how it really benefits Alfheim Capital, even though the others are just getting a 1x multiple of invested capital. They get no real benefit yet. For the next step, we then want to link in everything into the post-Series A cap table and calculate the ownership percentages there. So to do this, we need to go through and actually calculate the total number of options outstanding right now. So to do this, we can go up and take the co-founder shares and then any shares that existed prior to this, and then we can add the new shares that get created in this round. Now, we're not going to change anything with the options here, so I'm just going to leave these blank, and I'll just say that the total shares equal the number of actual shares and then whatever the employees had in their options pool. And that means that we're not actually going to have any new shares from options issued in this round because the 133,000 of options existed before this and it still exists after this, so no changes here. The post-money valuation in this case will be based on the total number of shares times the price per share in this round. And now we can link in everything here. So the co-founders are not getting any new shares. The employees may get options, but in this case, they actually don't get anything. And then all these investor groups do get new shares in this round. So let's do this, and then let's just sum up everything here. And we're just getting to the total number of shares at the bottom. For the ownership percentages, we'll take all these and then divide by the share count at the bottom to estimate this. And let's add this up to make sure it actually sums up to 100%, which it does. And then for the value, we take this fully diluted ownership and then multiply by the post-money valuation right up there. So we have all this, and then we can sum these up and get to our total value down there. So this is how it works, and I think you can see the problem, which is that the Series A investors here do not actually get 33% of the company. They actually only get 29% of the company, and it's all because of the fact that we gave out these shares to the safe note investors in this round. What it really means is that the real pre-money valuation was higher in this case. So the apparent pre-money valuation was 10 million, but actually, if you add up everything that gets created for the safe note investors, it was more like 12.25 million. And if you run the math with these numbers, you will see how this actually produces the 29% ownership that the VC investors get in this priced round. So there are solutions and there are different ways to set this up. You can calculate the conversion based on weighted averages or based on dollars invested. These are some more advanced methods, but people have understood this as a problem, and there are different ways to handle this, but it depends on how the agreement is set up and what all the contracts here actually say. One other complication here is if there is a change to the options pool, that is also going to create some more dilution for the Series A investors. So what often happens is that the options pool for employees is upsized in priced rounds like a Series A. So if it's 10% for the employees, maybe they get 20% after the round takes place or as the round is taking place. This means that the employees get free potential shares in the company, and that means that the seed and the Series A investors are going to be further diluted. To calculate this, we can take the total non-option shares, we can divide by 1 minus the new option pool size percentage, 20% here, and then we can grant new options based on the total number of shares times this option pool size percentage. Let's go into Excel and do this. I'll say 20, and then for the total shares after options pool upsizing, we'll take this number and then we'll divide by 1 minus 20% because we are going to create new options in this case. And now you can see what happens. The employees get 400,000 worth of new options. And so they end up with over 500,000 worth of total shares. And now the Series A investors are down to about 25% ownership, and even the SafeNote investors get less because effectively we're giving these shares away for free to the employees as part of the options pool upsizing to incentivize and retain employees. The point is that the Series A investors now own only 25% of the company, which is down pretty significantly from the 33% they thought they were getting, and it's all because of the free shares that have gone to the employees, and then the SafeNote investors and how their shares effectively boosted the true pre-money valuation here. This takes us into the last part. Are SafeNotes worth it? In my opinion, not really, because I don't think many of their advantages hold up quite as well. Now, back in 2013, now over a decade ago, priced rounds were more expensive. It cost a lot more in legal fees. They were more difficult to set up. A lot of founders didn't want to negotiate their valuation. If you think about it, something simple like this 10 million assumption in Excel could be weeks of negotiation in real life, and a lot of founders just didn't want to deal with that. But I think these days, priced rounds have become cheaper and easier. There are standard templates available, and so the benefits of SafeNotes have decreased over time. There are also many disadvantages of SafeNotes, such as the fact that they can create messy cap tables and unclear ownership. Something like this would almost certainly create some type of conflict and cause some renegotiation between the investor groups over how the conversion is handled, for example. And when there's an exit or a company wind down or shut down, you can get even more problems. If the company fails, SafeNotes are not really debt or equity, and so the treatment is not always clear. And although some people claim that SafeNotes do not actually set a valuation, if you think about it, if there's a valuation cap attached, effectively you are setting a price, even if it's not quite the same as the valuation in a priced round. So I think the real reason why Y Combinator and other startup incubators push SafeNotes is because they knew that most startups would not even make it to their Series A rounds. The startup failure rate is very high, and so they thought it was better to just get everyone cheap and quick funding, let the companies that do well rise to the top, and they can deal with ownership problems later. They probably figured that successful companies, if they really take off, are going to have much bigger issues than SafeNotes in future rounds, so it wouldn't be a big problem. And in some sense, they're right, but I think it's also a bit of a cynical way to run startup investing and to operate incubators like this, to go in with this assumption that you're just going to get everyone quick and cheap money just because you know that most of them are not going to make it. Again, this is all just my opinion, but I do think the numbers and some of the issues that startups have encountered with SafeNotes over time support this. So to do a quick recap and summary, SafeNotes in a seed round, the most important thing to understand here is that nothing actually changes. The company's valuation doesn't change. They get money, but the share count doesn't change and the ownership doesn't change. When you have a priced round, such as a Series A, you get conversions based on the cap and discount and the price that each different group gets. You have to go through and calculate the shares granted to each group or the shares purchased by each group based on these numbers. And then you have to go through and calculate the cap table again. The options pool can make it even more complicated because effectively this represents another grant of free shares to the employees, which means that the Series A investors are going to be diluted once again by something like this. So the bottom line is that SafeNotes may have made sense a decade ago, but over time, their advantages have decreased and their disadvantages have piled up, especially as companies that raised money back then have encountered problems later on as a direct result of these instruments. So that's a little bit about SafeNotes. Hopefully now you understand how they work and you have some Excel examples of how to set this up in real life.